Hey there, traders. If you've heard that term credit spread before and it leaves you feeling confused, you're not real sure what it is, I want to simplify what a credit spread is for you in less than 3 minutes. So, a credit spread is simply an options trade where you get paid upfront to take on limited risk. So, you're going to sell one option and buy another option that's further away from the current stock price. And you're going to collect a net credit when you open this trade. Now, the key word here is that it is limited risk. The risk is defined before you ever place that trade. Now, for example, let's say a stock is trading at $100 a share, and you believe that that security is going to stay above $95 over the next couple of weeks. So, what you can do is sell the 95 put strike and collect, let's say, $2 for it, and then buy the 90 put strike and pay $1 for it. So, you collect $2, you pay $1. All in all, you have a net credit of $1. And that's $1 per share, and an option contract represents 100 shares. So $100 per spread is the most that you can make on this particular credit spread. Now, your maximum risk is the width between these strikes, which is $5 minus the credit that you collect. So your risk is $4 or $400 per spread. You're risking $400 to potentially make $100, and you get paid for that up front. As soon as you place that order, the money is credited into your account. Now, you don't need the stock to skyrocket here. If it does go up quickly, you could realize your profit more rapidly. But all in all, you ultimately just need the stock to stay above $95 by expiration. And if it does that, both options are going to expire worthless and you keep the credit. That's it. Now, credit spreads are all about probability and structure. They're not about predicting huge moves. They're not about making a whole bunch of money on any one trade. Limited risk, limited reward is how credit spreads are designed to work. So, traders use credit spreads because the risk is defined. Your capital requirements are much smaller than buying shares of the stock. Time decay works in your favor. But they are not necessarily risk free. As I already mentioned, this example that we came up with, you're ultimately risking up to $400. So if the stock moves against you, you could lose $400. But even if the stock goes bankrupt, the most you could possibly lose is $400. So that's why risk management always comes first here. Now, if you're new to trading credit spreads and you want more breakdowns like this or some specific examples, let me know in the comments. I've made a few other videos along these lines, but I am happy to help simplify this stuff so that it makes sense quickly for you and you can begin using credit spreads in your short-term trading. We'll see you guys next time.